There's no doubt about the fact that when one only looks at the fundamentals of Alibaba, a business that averaged almost 50% in revenue growth over the last 5 years, the stock is valued cheaply. I think the main reason for this massive discount on the stock is not the firm's ability to continue growing in the future, but rather the uncertain future of the stock, which is caused by a multitude of reasons. Investors are first and foremost becoming increasingly worried about the fact that Alibaba may be forced to delist from the Nasdaq stock exchange. And as a result of this very pessimistic sentiment, Alibaba's stock keeps dropping and is now trading around 60% below its all-time high, almost reaching its IPO price of 7 years ago. But how high is the delisting risk really? Well, this is the question that we are going to explore in this video, and I think I will share a more optimistic view and outline the first of 3 reasons why I think the fear of delisting is overstated. And I'll cover the other 2 reasons in a follow-up video. So without further ado, let's get started. Hello fellow intelligent investors, my name is René Zellman, and if you get some kind of value out of today's video, please be sure to leave a like and maybe a comment. Alright, Gary Gensler, the chairman of the SEC, so the Securities and Exchange Commission, he has recently warned that many investors may not fully understand the nature of their investments in Chinese companies. Put in a nutshell, investors who buy shares of, say, Alibaba, JD.com or Pinduoduo actually do not own a stake in the actual operating entity, but rather own a stake in an offshore shell company that gives investors a claim on the profits generated by the Chinese operating entity. And that's because Chinese tech firms use so-called variable interest entity structures, or in short VIEs, to list abroad and technically bypass Beijing's rules on foreign investments. Now it seems like investors in Chinese stocks are becoming increasingly concerned about the nature of this legal construction, and it almost seems like there's no end to the stream of bad news for Alibaba investors in particular. If we look at Alibaba's stock price again, we can see that it is trading around 60% below its all-time high, and over the last few months the business has lost hundreds of billions of dollars in market capitalization. Not only are Alibaba investors worried about the nature of VIE structures, but the firm's growth has also slowed down recently. And if the regulatory crackdown on big tech firms continues in China, Alibaba's business may be further affected. Moreover, Alibaba is forced to, or technically forced to donate billions of dollars to common prosperity. And on top of all of this, investors also fear that the Chinese e-commerce giant may be forced to lose its primary listing in New York, because just recently the Chinese government forced the Chinese ride-hailing company Didi Global to delist from the New York Stock Exchange and pursue a listing on the Hong Kong Exchange. Because the CCP, so the Chinese Communist Party, is concerned about data security. And as I said, investors are worried because Didi Global's decision to leave the New York Stock Exchange seems to imply that other companies will have to follow the same path. It seems as if Beijing wants to keep tight control of Chinese companies and is pushing them to go public closer to home. But is that really the case? As I said, personally, I'm inclined to say that I'm more confident than ever that Alibaba will not be forced to delist, at least not in the near term. And before I explain why I'm so optimistic, let me be fully transparent here. I do own shares in Alibaba, and I'm neither a financial advisor nor a legal expert when it comes to VIE structures. And on top of that, I think there are a lot of moving parts here in the case of Alibaba specifically, and it's probably very hard to predict with any degree of certainty what the Chinese Communist Party is going to do in the short and near term. So just take everything I say in this video with a grain of salt, and of course always do your own due diligence. So here's the first reason why Alibaba won't be forced to drop their listing on the Nasdaq. Every country with a major stock market has its own security regulatory institution. There is the SEC in the US, for example. In Europe, you have the European Securities and Markets Authority, or in short, ESMA. In Germany, we have the Federal Financial Supervisory Authority, better known as BaFin. And in China, you have the China Securities Regulatory Commission, or in short, CSRC. Now, interestingly, as investors' worries intensified recently and the sell-off of Chinese securities continued, the CSRC itself chimed in and released a statement in early December 2021. And obviously, this statement didn't get much media attention as it doesn't evoke any fear and therefore will not get many clicks. So let me just highlight a few key passages from that official statement that, in my opinion, highlight that at least the Chinese authorities have no intention to push all Chinese companies to delist in the US. So here are the most important passages. Recently, individual media reports that Chinese regulators will prohibit companies with variable interest entity structures from listing abroad and promote the delisting of Chinese companies listed in the US are completely misunderstood and misinterpreted. In terms of US-China audit and regulatory cooperation, the CSRC has recently had frank and constructive communication with the SEC, the Public Company Accounting Oversight Board, and other regulators on resolving issues in cooperation, and has made positive progress and advancing cooperation on some key matters. We believe that as long as regulators on both sides continue to uphold this principle of mutual respect, rationality, pragmatism, and professional mutual trust in conducting dialogue and consultation, we will be able to find a mutually acceptable path of cooperation. The CSRC will also continue to maintain open communication with its US regulatory counterparts in an effort to resolve the remaining issues in audit and regulatory cooperation as soon as possible. Now I'll add a link to the English translation of that statement to the description box down below. Now, in addition, the CSRC has released a similar announcement earlier this year. In September, they have commented that, quote, "The capital markets in China and the US both have global significance and are increasingly interconnected. It is our belief that Chinese and US regulators shall continue to enhance communication with the principle of mutual respect and cooperation and properly address the issues related to the supervision of China-based companies listed in the US, so as to form stable policy expectations and create benign rules framework for the market." The CSRC has always been open to companies' choices to list their securities on international or domestic markets in compliance with relevant laws and regulations. Many promising companies are growing rapidly in China, which are potential high-quality issuers in capital markets. In an improving market ecosystem, listed companies that have solid operating performance and good corporate governance will naturally attract global investors. So, long story short, I think it is quite evident that the Chinese regulators are stressing that they respect companies' choices on where to go public and will continue to do so in the years ahead. Alright, and that's it for today. Make sure to subscribe to the channel to be notified when I release the follow-up video. And as always, may your finances and investments prosper. Good luck.